Going to dive into our last pop quiz for our investment unit. And again, this is one warning about these pop quizzes, and that is don't just go through these and just kind of, they don't really count for anything. This is an opportunity for you to see where you're at as far as your understanding of concepts. And if you're still struggling after a pop quiz, then you need to like go back and review stuff. We need to have a little chat session. Maybe we have a Zoom session, whatever, to go over things you're still struggling with. Because these are kind of, again, a barometer, a measurement of where you're at. And also, too, don't just have the webcast up on one screen and take the pop quiz for the first time on another. That does you no good. Take the pop quiz first on your own, independently, no notes, okay? See where you're at, and then watch the review quiz. Take notes on that on any area you're weak on. Contact me if you have any questions or need some help. But don't take shortcuts. If you take shortcuts when you take the test, and again, tests in my class are 80% of your grade, and it's going to come back and bite you. I should say it's more like 60% if you throw out the budget challenge piece. But anyway, it's a big part of your grade. So don't take shortcuts on these quote unquote non-counting assignments, because they're going to lead to the practice is going to help you prepare for these exams. Okay. What is the role of the SEC in the stock market? It's kind of a different version of a previous question we've had, and that is the police. They are the enforcement of the government to make sure that everything being done on the stock market is fair and accurate. When companies report their financial results, for example, those are audited and checked according to Securities Exchange rules. Calculating total shares of a corporation times their stock price. We call that market capitalization. Market capitalization. Okay. And so time out here, one moment. So again, I just want to give you another visual here. If we pull up Microsoft, their current market cap, or if I was to buy all of the shares of Microsoft Corporation, it would be $1.332 trillion dollars. That's a big number, trillion. Okay, market cap again is the total number of shares of all the shares that are out there that can be bought times the most recent stock price. Kind of a thumbnail valuation of what that stock is worth at a point in time. All right, where different investors' money is pooled together. We call these mutual funds. I had a little video on that with my 2 cents friends. And what we're doing here is rather than each of us buying individual shares, we're taking our money, and 401k accounts are usually like this, where your money is taken out of your paycheck, sent to this investment house, and they're pooling all this other money from other employees, and they're going out and buying individual stocks. I might not have enough money to buy those stocks individually myself. So rather than owning a share of a company, I own a little piece of a mutual fund, which is in turn owns a share of that stock. So it's kind of a proxy ownership or a third party ownership of stocks that I'm taking on with mutual funds. And most investments, because people have asked me in the past, so have you invested in stocks? Well, yes and no. And I haven't gone directly and been like a day trader with an E-Trade account and gone and bought stocks. But I have a lot of money tied up into these mutual funds, which are in turn buying stocks with pooled money, my money, and other people's money. As that video showed, it's like one big recipe. Okay? By taking a bank loan or selling bonds to invest, the corporation is said to be using this tool to raise funds for its business. So I was involved with a fundraiser. I use that term loosely. About 20 years ago, I was asked like the day before, hey, you want to go to Denver tomorrow? We're doing a bank presentation. I was working for our high-speed cellular company. And I said, yeah, sure. And I ended up going down to Denver, down to PNC Bank, which I actually drove past last summer on the freeway going through Denver. And we were trying to raise $20 million to grow our high-speed internet business. And I got to be part of this day-and-a-half long negotiation presentation as far as this PNC Bank potentially loaning our company $20 million. So if companies want to grow and they don't have the immediate cash to do so, they want to grow, they want to go into new markets, go into new products, go into new countries, whatever, and they need to raise money. Generally, they're either going to use equity or ownership in their company. Think Shark Tank, where the entrepreneurs who are presenting to the sharks, if you ever watch that show, are giving away a percentage of their company and then getting cash in exchange for a percentage of the company. That's one way, is equity. But in this case, if I'm taking out a bank loan, I'm going to go to a bank like PNC, this example with the high-speed company I was with, bank loan, or selling bonds to investors. So corporations regularly sell bonds, and actually individual people loan monies to corporations, even like Microsoft or Walmart or whatever. They actually have bonds where people will loan them money and they'll use that money and pay it back over time. All right, not an investment, not a stock, but a bond where they are borrowing money. So when they do this, we use the term they are using debt to raise money for their business. So the two most common ways corporations or big companies raise money, cash, to operate, I should say not to operate, but to expand, is either through debt or equity. Equity, again, is be giving away an ownership share of their corporation. What is capital as it relates to a business investment? This is simply cash needed to run your business. If you don't have capital, you are not going to survive very long. All right? And that's why cash flow projections over time are a key part of any new business. I've been involved with more than one startup before, and we would do cash projections and make sure that there wasn't a point where we were running out of cash. Because you need to pay your employees, you got to pay the bills. You also have to invest in your infrastructure and your equipment and all that as you expand and grow. All right. Going back to our investment allocations review, range asset allocation categories and risk from lowest to smallest. And I want you to pause this just for a second. Don't wait for me to just give you the answer. Pause the video and you come up with the answer first, and then we'll chat about it, okay? 3, 2, 1, pause. Okay, I'm back. And so here we go. Lowest risk. Well, fixed growth is kind of like a glorified savings account full of certificates of deposits and money markets and stuff like that. So fixed growth is going to be my lowest risk. What would be next? Well, some people say small cap, but those are small companies. Those are a little bit more risky. Large cap are my big established companies, and they're going to come next. Then small cap, and again, it kind of depends on what economic conditions are, and again, you could argue this in different ways, but small cap's going to come next. And finally, when you invest in international, because it's outside of the control of the U.S. government, and there's all kinds of crazy things that can happen. However, international investments can also grow like crazy as well, but that would be your fourth option. International would generally be, I use that term generally be the most risky. The Dow 30 companies would be all part of this asset allocation category. Again, these are large established corporations for the most part. They are all large cap, more than $10 billion in market capitalization. Market capitalization, again, is the value of all of the shares of that stock and how we determine risk among companies. Why would investing in a large cap company be less risky than that of a small cap company? Well, there's all kinds of reasons. There's available information. They have access to capital. They have a longer, I'd say, proven track record. Information is easily available online, whereas small caps not so much. Okay, so all kinds of reasons there. Number 9, although the world's economies are becoming more interrelated, it's still likely another economy somewhere is outperforming the economy of your home country. Again, what we're talking is international investments, or somewhere out there, especially like COVID, different countries have been affected by COVID. And so some of them are actually doing much better right now than the U.S. investments might be. So international, somewhere out there, some country is doing better economically than the good old U.S. of A. If you're nearing retirement and wanting to protect your investment, which would be the best fund to invest in? Now, I've been working with a financial investor in the Tri-Cities, as I think I've mentioned before, and I'm not retiring yet. I'm a few years away, but we're kind of pulling back a little bit. When you get to the very end, and say you're a year away from your retirement, you don't want to play with your money. You don't want it to like start slipping away from you. All right? And maybe if you want to just have things like stay the same, status quo, you might want to go for fixed growth. You're not going to get much of a return, but very much less risk. Because we just saw when COVID kind of hit in late February here in the U.S., we saw over about a 5-week period of time, the Dow lost about 1/3 of its value in a quick period of time. So if you're about ready to retire, you don't want that to happen. So fixed growth would be your best option if you're right near the finish line. What is the term used for general decrease in stock prices? Again, we have the bear and the bull. The bear tries to pull the bull down. We call this a bear market when prices are going down. That's kind of what we've been seeing here in the stock market. Even though it's kind of been up and down and back up again, depends on what day it is, but bear market generally for the most part. Number that represents the cumulative performance of a group of companies. This may be the third time we've reviewed this. This again is a stock index. You have one number, and again I'll just put points in parentheses. Points is the measure, the unit of measure of the stock index. We're taking all these companies and their per share values, 30 of them in the case of the Dow Jones, using a weighted average and throwing them all into one big number. Okay. Stock market crash of October 1987, the day I closed on my first house. It was actually cost me thousands of dollars in my buying in my house and what the points were for interest rate and stuff like that. That was the computer. The computer caused the big crash of 87, and because they didn't know when to stop. People had programmed these computers to trade for them, and all of a sudden everything was trading down, 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 down. It was like this big sinkhole, whirlpool of computers trading, and the stocks drove down. And so now the stock market has put in what are called circuit breaker programs, and they will shut down automatic electronic trading if the stock market has some issues. And we've actually seen that in the last couple of weeks. I believe there have been some circuit breakers go down when, like there was one day the stock market dropped 2,000 points, like a record in one day. Spreading your risk across multiple investments. Again, we call this diversifying. Again, I'm just covering some terms we've covered several times before, kind of as a last review here. We've talked a lot too about this one, dividend. And one more time, percentage change on number 16, percentage change. I'll do it one more time. See, Reardon, you've done this like 3 times. I know I have. We have X1. We're going to pretend this is a timeline, right? Let's put this over here a little bit farther. X2, and then my arrow. And you've seen my arrow, haven't you? Let's go over farther. Okay, there's my timeline. Point in time. Now understand, you could have an increase or a decrease. Now step back just for a second. I had a stock price of $58.38. Okay, in 1999. 10 years later, after that big, enormous drop in the big valley in the stock exchange, it dropped to $16.15. Okay, right there you'd say, okay, we already know it's going to be a percentage decrease. It's going down. Now, is it going to be ginormous? Well, nothing can decrease. In the stock market, you can't lose more than your entire investment. So you know it's going to be less than 100% or minus 100%. You can see that it's gone down a lot, 58 to 16. So we can predict that this is going to be a fairly sizable percentage decrease. So if you come up with like a decrease of 3%, for example, you know that doesn't smell right. Just step back and go, yeah, that's a big decrease. Okay, so let's drop this into our equation. X1, our starting point, 58.38. Let's say X1 equals, okay. Again, I'm going to slowly get rid of my timeline here. If I go and read, like I said before, you've already seen this a few times. Just using my tools in front of me to calculate this with you. X2 was my ending point, and that is 16.15. get rid of my little arrow over there. Okay, so I got my starting point and my ending point. Again, we already predicted we have a sizable decrease. Formula again is, and if you need to jot this down, try it, x2, my ending point, minus x1, my beginning point. We call that the arithmetic change. How much up or down, value-wise, in this case it's dollars, did my stock price for Microsoft go up or down? In this case, we're going to have, of course, a arithmetic change of negative divided by, again, percentage change from what? My starting point. Okay, let's drop that into an equation. We have, I'm going to do parentheses just like that, my ending point, 1615, that's x2, minus my beginning point, 5838. Don't forget PEMDAS, when we do parentheses first, divided by, again, percentage change from what? 5838. Okay, and let's go see with my little handy dandy Microsoft tool here. Let's go forget that previous equation. I'm just going to say equals and drop that same. Whoa, Reardon, what are you doing there? Holy schmoly, what was that all about? I have no idea. Let's go back to my quiz here. Hey, you know what? I'm just doing this live, guys. Pardon me. Let's go highlight that again and copy. Still work a little better this time, I promise. Okay, equals, and there's my value, and we come up with 72. Let's go back to my equation here. x2 minus x1, 1615 minus 5838 divided by x1, which was 5838. So minus 72%, or I lost a large part of my investment. Whoops, skip around there. Okay, so again I had minus 72.3%, where I lost 3/4 of my investment over like a 10-year period of time. That's pretty significant. Okay, and again, that matches my prediction. This one here we can argue about all we want to, but these two ladies were playing tennis. Each person, when they won, they got $1. If they lost, they had to give the $1 back. Well, in the end, Susan won 3 bets, or she won 3 games, right? But in the end, Lisa won $5. So Lisa won $5 more, or 5 more games, I should say, than Susan did. Well, if Susan won 3 bets, and Lisa won $5, then Lisa won 8 games, 3 plus 5, right? And Susan won 3 games, 3. So a total of 11 games. Now you can argue with me all you want to, but there you go. Hope that was fun. And this is probably going to be one of your last preparations for the exam on investments. And I'll be doing another quick little video to walk you through that. Have a great day.